All right, ladies and gentlemen, I hope you had a wonderful day. I missed you guys yesterday, but we're back in perfect time because the stock market volatility is coming back. We had a very weird day today. You finally saw a reaction of some of the underlying factors. That is Powell, the Fed, the data, and everything else. Even though it looked like the market did not do much intraday, we held a gap down. And although we are just below 5,300, which was a new high, you got financial conditions moving a little bit. So we got a lot to talk about. The week is almost over. We have a little bit of data tomorrow, then the big data on Friday. But even so, we got a couple of things we're dealing with tomorrow. I have the plays. I have the keys. I got all the plays I made today. And then your questions and an economic lesson. So what I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning, baby. Run it.
Working to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farming never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, like I told you, the financial conditions are tightening. There was a very weird effect today because if you look over the last couple of days, it is very easy to blame NVIDIA, but it kind of doesn't make that much sense. What we have noticed over the last 4 days, pretty much since NVIDIA's earnings, everything except a couple of AI names in NVIDIA have been sold off. So why? Why is this occurring right now? Why have the bonds given up? If you haven't noticed, the 10-year, once again, we are above that 4.5. I think now it's at 4.6. And then all of the rate cut odds, they pulled back even further. Believe it or not, right here, right now, you are almost at one rate cut priced in for all of 2024. It kind of makes sense because we only have 6 more months remaining, but compare that to what you had 6 months ago. People were talking 7 rate hikes, so we don't have much time. Your election is about to heat up, and now you are watching those odds pull back, but why? And literally, there's 2 things. One, overseas, and we saw a little bit about that today. You had German inflation come in hot. We covered this in the morning. The market didn't move much, so it's not like we were discussing it all the way throughout. But if you also remember Australia, they had a surprise the other day. We are watching these inflation surprises return. Not to mention, that's pretty much what you've seen with all of our data, except for the favorable CPI that we had not too long ago. So that's one factor, but then on top of it, you are getting all of these Fed speeches and all of them starting to sound more hawkish. So although we are still near highs, and that's the part that's weird about it, you are getting financial conditions tightening. There is a slight reaction to what's going on overseas and some response here to these Fed speakers. So that's what we had today. I think we're going to see a little bit more of it moving forward. We'll talk about that volatility that's creeping, but now coming into tomorrow, if we are going to get a reaction, you have the GDP data, and that could be big, assuming it surprises. If it comes in line, then we shouldn't get much. But GDP, it'll tell us a little bit about prices and activity, and we're going to get a little idea here of how people are feeling about the economy or how it's done, and then the reaction will be on the bonds in terms of how they feel. But this could be a big one. Other than that, though, Friday, literally on the short week, ever since Tuesday, we have been getting ready for this, and we are coming off of a favorable CPI. Let's see if the PCE matches that, or will it do what we've seen in some of these other countries, which has not been good? So watch out for that. But now finally, this is what I mean. Not only are we watching rate cut odds pull back, the bonds getting at a dangerous zone. The bonds can quickly come back to safety if anything good happens and they go back below 4.5. But looking at where the short-term bonds are and those Fed futures, there's a huge gap even between the 10-year, and then not to mention the gap between equities and bonds. That's that divergence you should be used to seeing if you've been on this channel. But the thing about this now, you are starting to get real conditions for real volatility. It's being set right now. Low liquidity, low volume. You have positioning now. You have literally 25% of all hedge funds are holding NVIDIA right now. It's one of the highest concentrations. I think last time I saw this, it was like Micron in 2014, 2015. Y'all remember that? Some of you, where my OGs at? Literally, they called it the hedge fund hotel, but people were more in and out of it than they are with NVIDIA. But the thing is, you have a high concentration in a certain amount of names, and people, even this morning, some analysts were talking about how the levels of equities now are getting so large, there's actually a real need for downside protection. Even though the VIX isn't high, the fact is some of these prices have ballooned, at least in the AI tech space, where if we do get hit by bad data, if we go from pricing in no cuts to even rates, and we get surprises to your soft landing, no landing, or whatever it is, you now have enough gains where the downside could be very painful, especially if you even position late there. So is it going to happen? Who knows? But the point is, now to like end of the summer, we are kind of watching an environment be created. People might be a little bit more cautious, and that's why, too, these highs, we have been staying pinned around this 5,300 for almost a month now. So that is a big deal. I would keep all that in mind, but when it's all said and done, we have to take it a week at a time, and in the short run, we'll see where this data leads us. But now, let us get into the plays. So, right off the bat, I got a couple of plays. Two of them I made a play on. One of them I wanted to make a play on here. I saw this one after hours, right as I was getting ready to shoot the watch list for you guys. Palantir, they came out with news after hours that they got a $400 million, I think $450 million contract with the government for some Maverick system or some Mavis system, something of that nature. But point is, they have been holding that $20 level. They're in the AI automation thing, a government contract. That could be very good news. Let's see how it plays out tomorrow. But what I'm saying is, like, it's pinned at that 20, still kind of a high price, but not too long ago, after their last quarter in the beginning of the year, they were trading around like 26 to 28. So add that to the hype. Maybe not too much to focus on tomorrow after the GDP, and then it has a good news driver. This one can definitely be interesting. So watch out for that. That is play number one. Then play number two. This one I made a play on, but Pinduoduo, there was news near the end of the day that was saying that there might be a crackdown on the whole Shein thing with Shein and Temu, and I saw this news before, but we ignored it. The only reason why I liked it, because it came out towards the end of the bell. Usually, or the end of the day, I usually like those rumors because they kind of just drop it at the last second, but this play is very weird. I did short 100 shares at like 150, 190 or 150, 90, pretty much right where it is now, but like I'm telling you, in the short run, last time this news came out, I ignored it, but if you guys do remember, I think it was like right here around earnings, the news came out and we had a big hit on it. So the fact that it's trading a lot higher out of any of the China stocks, Pinduoduo has been able to make up a lot there. So I like it. If we get any sort of negative news there, maybe we could say this falls into the election pandering plays, but I'm only looking for something quick. I don't want to hold it for too long, so we'll see how that plays, but definitely watch if that news ends up developing. That is play number two. And then finally, play number three. I made a quick play on this one after hours, still holding, and I got clapped a little bit, but I went with a smaller size than I initially wanted to because it had some of that gap fill earnings momentum going on. But CRM, and why I made this play is simply 2 standard deviations down, and this is beyond the shares. I just wanted to grab one there because their earnings wasn't bad. They guided lower for next quarter and then met the low end of this quarter, but they're one of those recovery stories, so market will punish them if they stop recovering, i.e. Disney. So that's a good one to look at as well comparatively, but thing is, CRM tomorrow, we'll see what those shares do. Other than that, though, in the morning, I do think that a 2 standard deviation move, we haven't seen too many of them. The ones that hit today, like DKS and ANF, they really ran to the upside, so I'd watch for either a giant continuation or a giant reversal tomorrow. This one can be excited. So that is play number 3. As far as everything else, I made a couple of plays here, both today and yesterday. Since I didn't have a watch list yesterday, I did make a couple of plays that I included, but this morning, if you heard the first bring, it was like a couple minutes in, I saw that the Russell was down 1.3. We did gap down like 0.6, and although the bonds were getting killed, I was like, man, Russell is kind of near one of these prices we were playing it towards the end of the year. So I wanted to grab a small one that says MKM. That should be M2K. I don't know why it says MK. Is it MKM like a motorcycle? I don't know, but M2K, this is the micro Russell. The RTY is the big one, but thought I'd grab two, and I was kind of looking for that liquidity bounce. There was a little bit of a bounce on the markets. I went for the Russell because it was underperforming, but keeping it small there so it doesn't have to go too crazy. But that was the first play. Then DKS, they had the great earnings, and this play kind of annoying. But I saw a really cheap option in the morning there on the continuation. I grabbed the 260 call. It was still far out of the money. It's for next week, but I grabbed it for 10 cents, and it was cheap. It literally, at one point, it went up 600%. I saw a couple people get filled at 600%, bought it for 10. It was going for 60, but I couldn't get filled, and then it dropped, and I think it closed around like 100 or 200%. So not bad, but still holding. If it doesn't really rip, probably missed that opportunity and lost the $10. And then I grabbed 10 of Pure Storage June 85 calls. Had a little bit of time. They were 23 cents. I was playing the earnings, so I also grabbed a 50 put for 35 cents. A little bit outside of 2 standard deviations, but this has been one of those data center AI plays. I thought I would get into it if it did have a surprise there. Last time they had the earnings, they moved double what was priced in, so I figured maybe it could get lucky there, especially with all of the AI news and everything of that nature. So there was that. Then the Pinduoduo short, like I told you, the CRM, and then yesterday, 2 big L's, man. I guess one of them you got to see like recently in the short term, bro. Those little penny stocks, man. Again, even the MPW held up a little better on the leap. Otherwise, I never grabbed any of those. I went for my MCT, kept it strict on a week, and then I held like one extra day because I didn't have time to close it on Friday. And then I took a $1,000 loss. It was like $900, but still pretty bad. Good thing I made some of the money back on some short-term trades, but like literally, I gave up all that work to lose it on a penny stock, man. And then my bond plays from earlier this year, I was having a good streak on the bonds, and then these two just murdered me. So I still got a couple of gains coming in from the end of last year, but especially with depending on how this yen plays out, it will get interesting for my standing on that. The good part, remember I was just telling you I need some cash. So although I took a big loss on these plays, it released a lot of cash on the future. So kind of bittersweet, but took a big loss. I want to tell you about it. You can make fun of me, do whatever you want on it, but hey, this is the reality. And honestly, with some of the questions we have today, I'd rather show you this than not, but at the very least, I don't think I'm going to touch bonds until we get some settling out. Maybe one more big flush in bonds, I might be tempted to buy it in, but it just feels, because every time the bonds start to give back up after getting hype, you will get a random pop, but maybe we'll see. Otherwise, they have not been that good, but that is all I did today. As far as the questions now, I got some good ones, and I think it makes sense with what we're talking about here. So the first question was, can you explain? They actually, it wasn't a question. They just yelled at me. I literally, I copied and pasted too. You'll see the other one. I don't know why. Why do y'all yell at me with future questions? But I said, explain the difference between a future and an option. So I don't have any tutorials on futures. You got to be careful with them. And at the same time, it's just like it's a completely different risk. I really do think you should look into them and don't fall for this scam of prop traders and people giving you money for all of that. I mean, you could either take my word for it or not. I'm not the one selling you anything, homie. So low key, though, options and futures are very similar. They both have expirations. They both derive their value from another asset. You know, an ES future derives its value from the S&P 500. An option on Amazon derives its value from Amazon. They use something else to get an idea of their value. A future, it is considered a contract, I guess. Not really. It's just a little different, but here it is. The size is completely different. Usually futures are buying in bulk, and then the literal difference is that a future is an obligation to buy while an option is the right to buy. So both of them you could sell out before any time of the expiration, but the difference is a future, if you're holding it by the end, you are literally saying I am obligated to buy the underlying asset at this future price that I agreed on, and then you put up the cash difference pretty much. You're giving that capital to make that trade. So you don't have the right to buy, whereas an option, it expires. You can exercise it at any time, and then again, you could sell it. But other than that, they are pretty much exactly the same. How the premium and the theta works, pretty much like time decay on futures is a little different than options because the time decay is between the rollover. I'm literally getting effed on that right now with my gold contract because I was going to close it out yesterday with the bonds, and that's why that ZB and ZT, this will relate to the next question too, but it's like I closed out of those right before the expiration because if you don't, you'll either get the forced closure or you have to get assigned. Most places will just force close you because 99, I think, percent of contracts, unless you're doing it on an institutional level, they just settle out in cash. But the main point is that at that like expiration of the contract, you have to either close it out and then roll over to the next one. That's where your time decay is because the next month contract will be at a higher price and then you're closing for a lower one. Every contract has a premium built in based on the time. So your theta in your decay comes from the time difference on each of the contracts or the futures. And again, there's different dates for futures just like there is for options, but it's all very complex. The reason why I use futures is when option premiums are too high or depending on what I'm going for, because simply you profit dollar for dollar on them. Although you are having the obligation, you are agreeing at that price. So if I'm obligated to buy at 5,300 on the SPY and then the SPY goes up to 5,310, I'm going to make dollar for dollar on that on bigger size. You can use micros or the bigger one, but that's why I like it because the premium, it happens depending on how you hold and then where it ends up. Sometimes that rollover premium could benefit you if things all go your way. You'll just make a little less money at the rollover. So I prefer the dollar for dollar at certain times, but then the leverage is insane. I've had very big gains and very big losses, both short-term and long-term when it comes to the future. So it's good, and maybe it could also hurt you, but it really kind of depends here on this next question. So I had another one of these. They said, Josh, can you go over the future contracts on your next watch list? Explain what the numbers mean, how much it actually costs to get into the play. Maybe if it goes up or down, then it is this dollar amount. So you've been listening because that is how I like to view it. You need to know how a future feels, like straight up, like how much does $1 on the SPY affect you, and different contracts, different sizes, it's going to play out. But like literally, it is better that I show you. This isn't something I could tell you. And that's why I'm saying, man, it's a pretty wild game when it's all said and done, but it's very simple. If you ever go to TD Ameritrade, you could come up here. Actually, here, it's not on the screen. Go to trade. You'll see an option chain, but like anytime you see where you enter in the ticker, click futures. And it tells you all of this. It tells you how much money you need to open one contract. Again, initial margin is how much you need to open the play, and then there's a margin maintenance required, how much you kind of need to have available to keep it open. Usually the initial margin is higher than holding it. So it's kind of a trip, but then again, that could wind you up in trouble if you're not really monitoring your account. And then again, you could lose more than you put in on a future. It's an obligation. It is not a right. Options, you have a limit to it. Futures, you do not. But all of the answers are here. It's telling you what one tick is and how much that means. So like on a micro 10-year, every 0.001 that it moves, it's going to cost you $1, cost $350 to open it. On an Australian dollar future, every 0.00005 is going to cost you $5. And then you could keep going down, different futures, different quantities, and different requirements and all of that. But you could see all of it. That is the answer, but maybe it's weird because tick sizes, you may be unfamiliar with that depending on what the asset is. Again, like options are in commas, and then there's wheat, and there's commas are basis points. You learned something new today, but the point is like, it's very complex, and the only way you're going to know is if you actually do it. You're not going to learn anything by just the numbers, and what I mean by all this is get real experience. It's very simple. Paper trade it. That's the best way to find out. Go on TD, open up the paper trade. You want to play with it, do it for like a month. See how it goes. Go in different size plays, the ones that you think if you're going to be doing bonds, gold, whatever it may be, and play around with it and see what it feels like to be in a trade that can move $1,000 in a minute or $100 in a minute, depending on the sizing that you're doing. So I think that is the best solid advice to get into futures. I hope this helps, but again, be careful with all of it, and none of this is a recommendation. Option trading, futures, scrimblers, gamblers, finders, advice, because on purpose only. Thank you for a wonderful day. All right, good. All right, perfect. But now, lessons, baby. Why the F do we trade? I'm not talking about stocks. That's if I was, get a long term, like you already know the answer. But today we are going to be beginning chapter 3, and we are going to be looking at just the whole international political economy, the benefits of trade. Do we need the WTO? Why has it developed the way that it has? And then we are going to get a nice little focus on economics today, and this is why I love it so much. And I'm also glad we got the foundation, and I hope you guys are excited to learn more. So as always, once I interject, that's opinion. Otherwise, you could kind of take what's on the page there and get both sides. If you have a challenge, feel free to let it be known. But like I'm saying, get the full picture. I'll weigh in with my opinion here and there, but hopefully you are able to kind of digest both sides of the equation. And then when we are done with these lessons, we are going to move on into applying them. But now, the political economy of international trade cooperation. It's crazy. I never look at this. It's just a whole spelling error. Look at this. Oh, the disappointing achievement realized from the Doha development round raised serious questions about the WTO's future. The WTO and its predecessors for the GATT have been at the center of the international trade system for 70 years. Yet today, the rise of new issues and the associated emergence of the mega-regionals highlight the willingness of some WTO member governments to pursue their trade policy goals outside of the WTO framework. The Trump administration's reliance on aggressive bilateralism and extended review of WTO rules constitutes another challenge to an organization struggling to justify its relevance. Today, perhaps more than any previous point in time, the centerpiece of the post-war multilateral trade system is under threat. Do the world's governments still need the WTO? Most analysts would argue, I believe, that the WTO remains an important and perhaps even necessary centerpiece to the global trade system. The claim that governments still need the WTO is typically framed in terms of a somewhat abstract theory of international political or international cooperation. This theory tells us that international cooperation is difficult even when all states stand to gain from cooperation, because the anarchical international system within which each states interact makes it difficult to enforce any agreements that they might make. The challenges associated with enforcing international agreements creates opportunity for some states to take advantage of others, and the fear of being exploited by others can make states reluctant to enter into cooperative agreements. As a result, cooperation is stymied. States are worse off than they would be in the specific context of world trade. This logic suggests that countries could gain substantially from cooperation that liberalizes trade, yet because some governments may want to exploit others by choosing to keep their markets closed to imports while exporting to economies that have liberalized, for instance, and all governments want to avoid being exploited in this fashion, governments are unwilling to make agreements that would liberalize trade. Consequently, societies are deprived of the benefits that trade confers. Societies often solve such cooperation problems by creating common institutions that help them enforce agreements. This is how and why the WTO remains important. The WTO helps states enforce trade agreements, and in doing so, enables states to capture the mutual benefits that trade provides. The WTO performs this role by providing common rules that provide enforceable standards to which states' trade policies must conform. The WTO helps states collect and disseminate information about the degree to which specific trade policies do, in fact, conform to these standards. And finally, the WTO enables states to sustain cooperation by helping them adjudicate the disputes that do arise. The WTO remains important, therefore, because it enables societies to cooperate and capture the welfare gains that trade offers. This chapter develops the logic of international trade cooperation in 3 essential steps. First, we examine trade theory to gain a firm understanding of why trade offers welfare gains to all countries. The examination is important in its own right, but it also highlights the gains available from an international cooperation aimed at liberalizing trade. Second, using a standard model of cooperation, the prisoner's dilemma, we examine the cooperation to capture the welfare gains available from trade is difficult. And then third, we examine how the WTO helps governments enforce the agreements they reach. So once again, my opinion, often you hear enough, we need the WTO. I know some people, propaganda, but here's the deal. You already know some of the criticisms by now, and you should be aware from the last chapter, again, the Doha round and how things have delayed and how the WTO, it's funny because we could make this whole case, and that's why we need to understand certain things related to just why trade is beneficial. That's why we're going to do some economics here today, but the fact of the matter is there's RTAs and there's all these other things that are going to get in the way of all of it. So keep that in mind. But moving forward, The economic case for trade. Why should countries trade? The standard answer is that countries should trade because trade makes them better off. Grasping why exactly trade makes societies better off, however, can be tricky. As the prominent economist Paul Krugman has argued, even many scholars and journalists who spend their lives writing about the global economy don't fully understand why trade makes societies better off. Because understanding this rationale for trade is central to understanding the global economy, but can be difficult to grasp, we develop the logic of comparative advantage in some detail. We begin by establishing a few core concepts. The first is that production possibility frontier, PPF. Countries are endowed with factors of production in finite amounts. Consequently, any decision to use factors to produce one good necessarily means that the factors are not available to produce another good. A decision to allocate capital and labor to the production of computers, for example, necessarily requires the country to forego the production of some number of shirts. These foregone shirts are what economists call opportunity costs, and the PPF allows us to measure these opportunity costs quite precisely. So we have talked about this in the past. That's what I'm saying. It's going to get good, but you should all kind of be generally familiar with this. Some of you, again, shirts versus computers. If you have gone through I feel like every college course uses this example in Econ 101. I'll give you an even better one. It's quite simply everybody talking about NVIDIA right now in AI. I mean, think about it. You're not a country. We're not talking about economic trade, but this whole opportunity cost. Think about it. Why buy NVIDIA? Why sell NVIDIA? What happens if you forego and you choose to go one route? What is the cost of not doing the other thing? So very, very good and basic, but continuing forward. Consider an illustrative PPF for the United States. Let's assume that the United States has a fixed stock of labor and capital that it could use in combination to produce two goods, shirts and computers. Suppose that if the United States allocates all of its labor and capital to computer production, it could produce 100 million computers. And if it allocates all labor and capital to shirts, it could produce 300 million shirts. If we connect A and B with the line, we have defined a PPF for the United States. Along it lie all combinations of shirts and computers that the United States can produce using all of its factors of production. As we move from A to B, capital and labor are reallocated away from computer production to shirt production. The slope of the line, called the marginal rate of transformation, tells us exactly how many shirts the United States foregoes for each computer it produces. In this example, every computer the United States produces costs 3 shirts. Because an autarkic country cannot consume more than it produces, the PPF also defines the limits of possible consumption. So here is the figure that it pretty much described. I want to show you guys these after, because sometimes, you may kind of just focus on the chart, but look at what it's saying. For every computer that you made, and it has a cost in shirts, again, as you just slide this thing down, the more computers you make, the less shirts, the more shirts, the less computers. Ta-da! This is, again, these charts and these curves and the marginal rate of transformation, this is all like Econ 101 stuff right here. So I'm glad that we get to touch on it, but that's what I'm saying. So it's all important. So moving along, we could draw the PPF either as a straight line, as in our example, or as a curve line, which select depends upon the assumption we make about the nature of the opportunity cost that the United States faces. A straight PPF embodies the assumption that the United States faces constant opportunity costs. Every additional computer always costs 3 shirts. If we assume constant opportunity costs, we also implicitly assume that the United States enjoys constant returns to scale in production. This means that whenever the factors employed in shirt production are increased by some factor, we will increase the number of shirts produced by the same factor. Double the amount of labor and capital employed in shirt production and double the amount of shirts produced. Alternatively, we would assume that the United States faces increasing opportunity costs and connects points A and B with a curved line that bends out away from the origin. The shift from producing 49 million computers to 50 million computers costs 3 shirts. Yet, when the United States moves from producing 89 million to 90 million, it costs 7 shirts. Thus, the opportunity cost of producing each good rises as the United United States dedicates a larger share of its factors to the production of a single good. If we assume the United States faces increasing opportunity costs, we are also implicitly assuming that factors yield diminishing marginal returns. This means that the number of additional computers the United States can produce for each additional workers employed in a computer production will fall as the number of workers employed in computer production rises. Most contemporary models assume that factors yield diminishing marginal returns. To keep things simple, we will assume constant marginal returns. So if you're not understanding what it's talking about, we'll see it, but right here, this line, there's a couple of curved lines here, but you see how this was straight? That's what it's talking about every additional unit and the opportunity staying stable. So in economics, you could get a lot more curved lines, but like he's doing to keep it simple, he's going to pretty much keep it simple and straight. That is our assumption. Second core concept, consumption indifference curves help us understand the specific combinations of computers and shirts American consumers will purchase. Consumers will acquire shirts and computers in combination that maximizes their collective utility. Economists conceptualize consumer utility with an indifference curve. We assume that consumers prefer more to less, and therefore consumer utility increases as we move away from the origin. Some combination of shirts and computers, such as those at points A, B, and C in figure 3 and 1, yield the same amount of utility. If asked to choose between these three, our consumer will say, I like them all the same. If we connect every combination of shirts and computers, that provides our consumers with the same amount of utility. With a curved line such as UA, we have drawn the indifference curve. Our customer enjoys identical utility from every combination of shirts and computers that fall on UA. We can draw a second indifference curve that links the combinations D, E, and F. Each one of these combinations yields more utility than A, B, or C, and it is thus said to lie on a higher indifference curve. But our consumer is indifferent between D, E, and F. We could connect these three combinations with the second indifference curve, UB, where we are to repeat this exercise for every possible combination of shirts and consumers within this two-dimensional space. We would have a complete indifference map. So that's what these, curved lines that you're getting, your UA and your UB, it may seem a little bit there. I mean, the simple way to look at the indifference curve, it's simply explaining the trade-offs between two goods. I'm surprised he didn't talk about it a little bit more, but even on the consumer level and other things, just quite simply, people have budgets and they have other things where it's not like everybody or every country can do certain things. And if it's not looking at the consumer, countries and the natural resources, that's where things can be limited. Moving on, 3 additional characteristics of indifference curves are important. First, indifference curves typically slope downward. This slope, called the marginal rate of substitution, tells us how much of one good the consumer is willing to give up to acquire an additional unit of the second good. Yeah, so he's explaining it. Second, indifference curves typically bend towards the origin. This reflects the assumption of diminishing marginal utility. The first computer provides a large improvement in utility. Each successive computer, however, provides a smaller increase in utility. Consequently, even though the consumer might be willing to give up a large number of shirts to acquire her first computer, she will be willing to give up fewer shirts to acquire her sixth computer. Finally, when we focus on production and consumption for an entire country, we construct community indifference curves rather than individual. Oh yeah, so you already know, baby. And rather than individual indifference curves. Community indifference curves aggregate utility for all consumers in that society. In this example, then, our community indifference curves embody the aggregated preference of all American consumers. Together, the PPF and indifference curves allow us to define equilibrium production and consumption of shirts and computers in this autarkic American economy. Production and consumption will occur at the point where the marginal rate of transformation, the slope of the PPF, is equal to the marginal rate of substitution, the slope of the indifference curve. That is, production and consumption will occur where the PPF and the indifference curve are tangent. This is point E in figure 3.1. So you'll see this a lot, and that's why these curves in economies are so important, but it's pretty much right where everything matches up. Ta-da, there's young E. Wow, it's beautiful, beautiful. So, moving on. Why must production and consumption occur only at this point? Suppose the United States initially produced and consumed at G. Society could gain greater utility at G and I guess I'm going to have to start throwing this in here, but G is right here. So again, here's your computers, 48 million consumers, computers, and then 180 million t-shirts. I don't know, can I leave this on the side here? Maybe that'll help. Consumers can shift to higher indifference curve by consuming fewer shirts and more computers. We would therefore expect consumers to demand fewer shirts and more computers, and we would expect production to shift in response, producing more computers and fewer shirts. Beyond E, consuming additional computers and fewer shirts decreases consumer utility. Consequently, consumers will begin to demand more shirts and fewer computers. Only at E is it impossible to achieve higher utility from a different combination of shirts and computers. Consumer utility is thus maximized by producing and consuming at E. Under autarky, therefore, equilibrium production is the United States equals 60 million computers and 120 million t-shirts. To see how trade changes this equilibrium, we must introduce a country for the United States to trade with. We will assume that the only other country in the world is China. We construct China's PPF just as we did for the United States. Figure 3.2. Let's suppose that if China dedicates all of its labor to capital to computers, it could produce 20 million computers. If it dedicates all of its labor and capital to shirt production, it can produce 400 million shirts. Connecting these 2 points yields China's PPF. So literally shirts here. If you did all of your production to shirts, 400 million, all of it to computers, you have 20 million. That is that chart. Again, this is your indifference curve right here, and then we are going to see where they meet. But given our assumptions, China's marginal rate of transformation is 20. Every computer China produces carries an opportunity cost of 20 shirts. We then find the point of tangency between China's consumer indifference curve and the PPF to identify the equilibrium. Production and consumption in autarkic, I don't know if I'm saying that right, China, based on our assumptions, equilibrium in consumption in autarkic China yields 13 million computers and 140 million shirts under autarky. So that's right here. Where you got computers? 12, yeah, as they say, 14 million, 13 million, then like 140 million shirts right there where they connect. You might have to, I don't know, you got to zoom in a little bit, but that's why they drew the little box line there for you. But we can now see how trade between the United States and China affects equilibrium production and consumption in both countries. Point 3. This one is a little bigger, but I'll keep it up there. Trade changes equilibrium production by causing each country to specialize in the production of one goods. The United States specializes in computer production and stops producing shirts. China specializes in shirt production and stops producing computers. Specialization arises from the conclusions each draws from simple price comparison. The United States acquires more shirts per computer when it buys them from China than when it produces them at home. A computer buys 20 shirts in China, whereas at home it only buys 3 shirts. And then let's see. Why should then the United States produce shirts at home when it can acquire them? Let me get you the chart back up here. For substantially less than in China. The United States thus stops producing shirts, produces only computers, and acquires the shirts it wants from China. Similarly, China acquires more computers per shirt when it buys from the United States than when it produces them at home. China can acquire a computer from the United States for only 3 shirts, whereas if it produces computers at home, it would cost them 20 shirts. Why should China produce computers when it can acquire them much less expensively from the United States? China therefore stops producing computers, specializes in shirts, and then acquires the computers it wants through trade with the United States. Trade thus changes equilibrium production in both countries. The United States specializes in computer production, and China specializes in shirt production. To see how trade affects both equilibrium. So even then, these charts, man, I know, I hope this doesn't get the next page gets even crazier, but it may seem kind of wild, but I think even with words, you should be able to understand them. There's so much going on. Usually I would show you the charts after, but I do kind of want you to get a feel for it, but hopefully you are understanding the rationale behind it. And think about what he said. We know economic theory, but we don't really know because there is still a lot of assumptions at place here, but this is so you could just understand the general theory of all of it. So To see how trade affects equilibrium in both countries, we need to know the price at which the United States and China will exchange shirts for computers. We know that this price must fall between somewhere of 3 and 20 shirts per computer. We could solve for the exact price that will arise, but we will simply assume that these two agree to trade at 6 shirts per computer. This new price is depicted in figure 3.3 with the dashed line labeled PT right here. So again, they both have it. This one's China, this one's America. This is your original curve without trade. And then the dotted line here, this is the new one with trade, assuming that you pretty much are trading one computer for 6 shirts. Now we must find the combination of shirts and computers that maximize consumer welfare in each country at this new price. To do so, we find the point of tangency between the new price line and our consumer indifference curve. So that leaves us right around here on both of them. These points are labeled CUS and CC. So CUS and then CC. Is that CCP? What? Equilibrium consumption in both countries has thus expanded beyond what was possible under autarky. American consumption expands from 60 greater utility, which is reflected in the higher indifference curve move, U2 and UC3 respectively. This additional consumer utility is the gain from trade. Trade between the United States and China is thus beneficial for both countries. So literally what it's showing you here is without trade, and then you're seeing just by maximizing and focusing on what you do better, now you're even getting that balance there where you're walking away with more shirts and more consumers and computers, and you're getting a better utility even in mass production there. That's another thing to think about with that whole utility factor. And then same thing with China. They are getting way more shirts and computers. In this scenario, it's a win-win for everybody. That's what this is all trying to show you. This specific example illustrates the broader claim that every country gains by specializing in goods. It produces relatively well, and trading them for goods, it produces relatively less well. This is the principle of comparative advantage. These gains are not dependent upon having an absolute cost advantage in a particular industry. The United States does not gain because it produces computers more cheaply than China. It gains because it can acquire more shirts per computer in China than it can at home. And these gains exist even if cost more to produce in China than in the United States. Thus, even countries that produce every good at a higher cost than all countries gain from trade by specializing in the goods they produce. This is the logic of comparative advantage. And this is where I'll tell you on a business sense, if you just understand what was said there, my brother, your income will go up a lot. It's one thing to make the money on the buy, but they're not saying they make their money on the buy. As long as you have an open market and the ability to get something from somewhere else, I mean, it's kind of the arbitrage to a degree. So hopefully that stuck out to you. But moving forward, what determines which goods a particular country will produce relatively well and which it will produce relatively less well? The Ricardian model, developed by David Ricardo in the early 19th century, holds that comparative advantage derives from differences in labor productivity that result from differences in technology. The Ricardian model suggests that countries specialize in goods for which they hold a relative advantage in labor productivity. The second model, the Heckscher-Ohlin or HO model, named after two Swedish economists, Eli Heckscher and Bertil Ohlin, were developed in the early 20th century, argues that comparative advantage rises from differences in factor endowments. Factors are the basic tools of production. When firms produce goods, they employ labor and capital in order to transform raw materials into finished goods. Labor obviously refers to workers. Capital encompasses the entire physical plant that is used in production, including the buildings, the house factories, and the factories on the assembly lines inside these factories. Countries possess these factors of production in different amounts. Some countries, like the U.S., have a lot of capital but relatively little labor. Other countries, such as China, have a lot of labor but relatively little capital. These different factor endowments, in turn, shape the cost of production. A country's abundant factor will be cheaper to employ than its scarce factor. In the United States and other advanced industrialized countries, capital is relatively cheap and the labor is relatively expensive. In developing countries, labor is relatively cheap and capital is relatively expensive. I encourage you to think about real wages, and right now, too, think about how the world changes and what that means, too. It depends. Heckscher-Ohlin or Ricardian model, that's up to you, too. Because countries have different factor endowments and face different factor prices, countries will hold a comparative advantage in different goods. A country will have comparative advantage in goods produced using a lot of their abundant factor and comparative disadvantage in goods produced using a lot of their scarce factor. In the auto industry, for example, payments to labor accounts for 25 to 30% of the total cost of production. The much larger share of the cost production arises from capital expenditures, that is, expenditures on the machine, assembly lines, buildings required to build new cars. In contrast, the apparel industry, wages paid to workers account for the largest share of production costs, whereas capital expenditures account for a much smaller share of the cost production. It follows that countries like the United States and Japan, with a lot of capital and little labor, will have a comparative advantage in producing cars and a comparative disadvantage in producing clothing. By the same logic, developing countries with a lot of labor and little capital will have a comparative advantage in producing clothing and comparative disadvantage in producing cars. Thus, in our example, the United States has a comparative advantage in computers and not in shirts, because the United States is abundantly endowed with physical and human capital and poorly endowed with low-skilled labor. China has a comparative advantage in shirts and not in computers, because it's abundantly endowed with labor and poorly endowed with human and physical capital. Comparative advantage tells us, therefore, that all countries gain from trade by specializing in the goods that rely heavily on the factors of production that they hold in abundance and exchanging them for goods that make intensive use of the factors of production that are scarce in their economy. Is that it? Yeah. Oh, yeah, there it is. Yeah, man, that's it. That's it. So, honestly, this is Econ 101. Now you should know what comparative advantage means. In trade, you even know the Ricardian model and Hector Olin and all of these stuff's going on. But, like, the point is, this is why it's all based off of this economic theory. You know, again, we were even talking earlier on stream today, 1800s and where this all developed from. So this is one of those economic things that the politics comes into it. That's why, if you think about it, all this stuff we listen to on stream, right? Whether it's the Fed and some of this stuff, it's usually addressing this. Anytime we're talking economy or anything with trade, WTO, this is something you have to think about. And that's why I'm saying, my homework question for you is, has anything changed in America recently? How do you think this stacks up now? You've seen a lot of changes in wages, real wages. We're watching certain things. Is labor expensive or cheap now? Or is capital expensive or cheap now? Look at the rates. There's a couple of things to think about there. But Chad, already another long one. I hope you enjoyed this. I hope this helped out. But now, that is your watch list, ladies and gentlemen. Make sure Andre Hoti ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, you got to pursue. That's it. You may want something. You got to pursue it, baby, with the same intensity you pursue everything else, baby. It's game time. But drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the morning. And on.